When recent graduates get their first job, the first thing most of them want to do is celebrate. Why not, right? But sometimes the celebration can lead to big purchases like getting a new car, something expensive that's way beyond their means. So today, Maribel Aber is here. She's a financial expert, lawyer, and former executive of the NASDAQ stock market. She's here to talk to us about how we can help our college grads plan for their financial future and not whittle their money down to nothing before they have a chance, right?
That's right.
Welcome
That's right.
back.
Thank you.
Good to see you here. It's tough. You're getting out of college. You spent all that time in college and you want to get out and do something fun with your money. And even if it comes to getting your first job, a lot of people aren't making that much money when it comes to their first job. But you're saying that they should still focus on saving their money, right?
Well, I like to call it, to not scare anybody, planning for your future. Right?
Okay.
And it's so important to start early because you're right on point right there. Let me give you an example
of
how you can start early. Say you're 20 years old, you're just jumping, you're getting a new job, and you want to invest. So just take $100 a month. $100 a month at a 5% compounded interest rate. By 60, your nest egg on that investment alone would yield more than $153,000. Now, if that 20-year-old had waited until they were 40, they'd yield about $40,000.
Interesting, a big difference. Part of it, it's really about education. You have to know this, obviously. It's too late for a lot of people to get to that, $153,000 mark, right? All right, let's talk about the investment vehicles that are out there for college grads that they can take advantage of. They're pretty simple.
That's right.
It helps. The most traditional form is just opening up a savings account,
That's right. Just open up a savings account. That or a money market fund.
Yes.
And that's offered through a mutual fund, and they actually tend to yield a higher interest rate, so that's something to consider.
Okay.
Another vehicle could be investing in stocks.
Yeah.
Exactly. We've all heard about investing in stocks. And what is it?
Right.
A stock is an ownership in a company.
And they've got time, too, if they want to invest in the stock market if you're young.
This is exactly, that you're not as risk adverse because you have the time, right?
Exactly.
So I would say do the research first.
Yeah.
You want to always do the research and look at things. I mean, everybody's on the internet right now, right?
Exactly.
So look at Yahoo Finance, look at Google Finance, and there's a new one that I just read about from the Wall Street Journal, FILife.com.
Okay.
So just different ways. Don't be afraid to look through it.
You've got to educate yourself. That's the only way you're going to end up learning, right?
Absolutely.
Okay.
Absolutely.
Mutual funds, ETFs also?
Mutual funds and ETFs. If you like stocks, but you want like a bigger, sort of diverse portfolio, an ETF is an exchange-traded fund, and a mutual fund is actively managed by a fund manager. They're secured pools interest of stocks, but the actively one as a mutual fund is continuously going in and out, in and out. So you want to also see if you're more into the ETFs where you have a static group or more into something like an actively managed fund.
And when they do get their first job, they have to look into the 401k plan. It's like giving money away, right?
That is my biggest point right there. You have to. I mean, the 401k plan is the retirement plan for the company and through the employees. And in 2009, you can contribute up to $16,500 now. And the way that most people do it is just contributing a portion of their salary. So the great news here is this is not reportable income.
Right.
So you don't get taxed until after you withdraw the funds.
Exactly.
So hopefully when you're older, right?
Exactly.
And the biggest selling point and why all employees should be in it is because a lot of times the firms match.
Yeah.
So, if you're putting in 3% of your salary and they match 100%, why wouldn't you take it? It's like they're incenting you to invest in your future.
They're leaving money on the table for you to take. All right, well, these are all good points. Thank you so much. Helping out a lot of parents out there and college students, too.